If you had $100,000, would you leave it sitting in a bank earning almost nothing, or put it to work in powerful Fidelity index funds with long term growth potential? The best part is that you don't need to spend hours analyzing stock charts to build serious wealth. We're not talking about small gains here. With the right strategy, these investments could potentially grow into millions over time. Choosing the right index fund isn't just about picking the most popular name. Growth potential, dividend yield, sector strength, and long term stability all play a major role. The Fidelity funds in this video were selected based on exactly those factors. At number 5, we have the Fidelity MSCI Consumer Staples Index ETF, ticker symbol FSTA. This fund focuses on companies that sell essential products people continue buying no matter what happens in the economy. Major holdings include Procter and Gamble, Costco, Walmart, and Coca-Cola. These are globally recognized companies with strong financial foundations that tend to remain stable even during economic downturns. Almost the entire fund is concentrated in the consumer defensive sector. It currently offers a dividend yield of around 2.39%, and over the last 10 years, its dividend growth rate has averaged more than 10% annually. Its long history of consistent dividend payments makes it attractive for investors seeking both income and stability. During the 2008 financial crisis, consumer staples declined only about 15%, while the S&P 500 fell more than 38%. That highlights the defensive strength of funds like FSTA. Historically, the fund has generated an average annual return of around 6.41%, meaning a $100,000 investment could potentially grow to roughly $2.3 million over 30 years, while also generating significant dividend income along the way. At number 4, we have the Fidelity MSCI Consumer Discretionary Index ETF, ticker symbol FDIS. This fund focuses on sectors tied to luxury spending, entertainment, and non essential consumer purchases. Major holdings include Amazon, Tesla, and Home Depot. Since most of the portfolio is invested in consumer cyclical companies, it has strong growth potential during periods of economic expansion. FDIS is heavily focused on growth and innovation. It benefits from rising consumer spending when disposable income increases, making it especially appealing for investors looking for aggressive long term growth. Although FDIS is not primarily an income focused fund, it still offers a dividend yield of around 0.76%. More importantly, its dividend growth rate over the past decade has averaged 11.22% annually. That means payouts have steadily increased over time despite the relatively low starting yield. The fund has also maintained consistent dividend payments for 10 straight years, creating a growing income stream for long term investors. Between 2010 and 2020, this sector delivered average annual returns of around 16%, outperforming the S&P 500's average return of approximately 13%. Based on historical performance, a $100,000 investment could potentially grow to around $112,190 after 1 year, $315,693 after 10 years, and nearly $995,230 after 20 years. After 30 years, the portfolio could potentially exceed $3.1 million while generating around $20,000 annually in dividend income, or roughly $1,665 per month. Over those 30 years, the majority of the portfolio growth would come from capital appreciation combined with reinvested dividends. Because of its sensitivity to economic growth, MFDIE stands out as a strong option for investors who want exposure to booming economies and long-term wealth creation. At number 3, we have the Fidelity MSCI Healthcare Index ETF, ticker symbol FHLC. This fund invests in the healthcare sector, an industry with consistent demand regardless of economic conditions. That combination of stability and growth makes it highly attractive for long-term investors. Healthcare has historically been one of the market's most defensive sectors. During the 2008 financial crisis, the healthcare sector declined only around 22%, while the S&P 500 dropped nearly 38%. This clearly shows the resilience of the healthcare sector during difficult economic periods. FHLC's top holdings include Eli Lilly, United Health Group, and Johnson& and Johnson, with these three companies making up more than 25% of the fund. Since nearly all of the fund's assets are invested in healthcare stocks, it tends to remain more stable during times of economic uncertainty. FHLC currently offers a dividend yield of around 1.26%. But the most impressive part is its 10-year dividend growth rate of 16.18%. This indicates that dividend payouts have grown strongly over time. The fund also has a solid track record of paying dividends consistently for 10 consecutive years, which is a major advantage for long term investors. Based on its historical average annual return of 9.24%, a $100,000 investment in FHLC could potentially grow to around $110,500 after 1 year, $283,315 after 10 years, and approximately $931,021 after 20 years. After 30 years, the portfolio could potentially reach about $4,063,315. At that point, annual dividend income could rise to approximately $303,540, which translates to around $25,295 per month in passive income. Over those 30 years, the portfolio growth could consist of nearly $4 million in capital appreciation, along with more than $1.5 million from reinvested dividends. Coming in at number two is the Fidelity NASDAQ Composite Index ETF, ticker symbol ONEQ. If you want exposure to technological innovation and the future of the modern economy, ONEC stands out as a powerful option. This ETF tracks the NASDAQ Composite Index, which includes some of the world's fastest growing and most innovative companies. The fund is heavily focused on technology and growth oriented stocks. Historically, the NASDAQ has significantly outperformed many other major indexes, especially during periods of rapid technological advancement. For example, between 2010 and 2020, the NASDAQ delivered average annual returns of around 17.5%, well above the S&P 500. Although ONEC is not a high dividend fund, it still offers a dividend yield of approximately 0.64%, while maintaining an average annual dividend growth rate of 7.35% over the last decade. Thanks to its concentration in technology and growth companies, the fund has produced an average annual return of around 14.44%. A $100,000 investment could potentially grow to approximately $115,080 after 1 year, $401,400 after 10 years, and around $1,577,234 after 20 years. After 30 years, the portfolio could potentially exceed $6.1 million. At that stage, annual dividend income could reach around $4,063. Over the long term, the majority of the portfolio growth would come from capital appreciation combined with reinvested dividends. ONEC is heavily weighted toward technology giants like Apple, Nvidia, and Microsoft. With those three companies making up roughly 40% of the fund, more than half of the portfolio is allocated to technology stocks, while the remaining assets are spread across communication services and consumer cyclical sectors. This gives investors direct exposure to industries driving the modern global economy. And finally, at number one, we have the Fidelity MSCI Information Technology Index ETF, ticker symbol FTE. FTEC stands out as one of the strongest choices for investors focused on the technology sector. The fund provides concentrated exposure to information technology companies that are shaping the future. If you believe in the transformative power of technology, FTEC is an extremely compelling option. Its top holdings include Apple, Microsoft, and Nvidia, and together these three companies make up nearly 50% of the fund. More than 99% of the portfolio is invested in technology stocks, covering everything from software and semiconductors to cloud computing and artificial intelligence. Although FTech currently offers a modest dividend yield of around 0.66%, Its 10-year dividend growth rate is an impressive 19.08%. This shows that the companies inside the fund are not only reinvesting for future growth, but also consistently delivering value back to shareholders. For long term investors, that combination can create both strong capital appreciation and a steadily growing passive income stream. Now let's look at what could happen if a $100,000 investment was placed into FTPC with an average annual return of 18.67%. A $100,000 investment could potentially grow to around $119,330 after just 1 year. Over 10 years, that investment could rise to approximately $586,063. If held for 20 years, it could potentially reach around $3 million.